Hi, this is Kirk with Forex Strategy Secrets. We're going to be discussing mastering Forex trading. Now, there's a lot of little things that we can do in our daily trading or our weekly planning that will help us to master the art of trading. And they're very simple. Now, of course, of all, you have to learn the technical things like all the indicators and how to do that. But there are just a few things that you can do to actually manage your activities. So the first one I have down here is to have some clear goals in mind and choose a trading style that is compatible to what these goals might be. If you are working a full-time job, one suggestion would be use larger time frames. The day, the 4 hour, maybe enter on the 1 hour. If you want to sit in front of the computer longer, then you can use some smaller time frames, maybe the 1 hour, 30 minute, 15 minute. If you start going lower than that, you're just you're going to get whipped around because the market goes up and down so quickly. By the time a new student learns what he should do, he's already lost the trade. So it's better to start with the larger time frames and then move to the smaller time frames if that's your style. But let the larger time frames give a chance for things to gel. You can make a decision if you're using the 1 hour to make a decision on. That gives you a long time to decide whether that's the right move to make. At first you might think you're overanalyzing, but that'll pass and you'll become more efficient at using the indicators and the time frames. And there are certain setups, and once you get used to those, then you set that in your goals. So set your goals a long-term, day, 4 hour, 1 hour, or mid-term, and I would stay away from short-term. Generally, that's where most of the people lose their money is in the short term. Okay, so have some goals. That involves having a trading plan if you're going to have goals in your trading. Okay, good trading involves expecting small losses. How many of you ever expected to get a loss? Well, we all expect to win 100% of the time. But if you get used to understanding that you are going to have a small loss once in a while, the losses are part of trading. And we'll go through a couple other things I'll share with you as to how to maybe minimize the emotional impact of those small losses. Once we get in, we want to be right all the time. You don't have to be right all the time. You just have to be right about a good range of between 60 and 70% of the time. You need to be right, and be right big, and when you're wrong, lose small. Don't lose big when you're losing, but expect to have some small losses. That will kind of balance out your trading. For example, if you have 60% win-loss ratio, and you have a loss, well, that's one out of the 4 losses you're going to have in a 10-trade series. Just go on to the next one, look for another win, and we'll go through some things that may help you with understanding how to do that. Okay, don't waste time on losing trades hoping they'll turn around. If you've traded long at all, and I know in the beginning I did this, I'd get a losing trade. I didn't want to lose. I knew it was going to come back. And several hundred pips later, I couldn't stand the pain anymore, so I closed the trade at a big loss. And it never did come back. Well, it did come back. It was a couple of years later when it came back. I mean, it was in the middle of I caught it thinking I was in a trend going up, and it was just a little retracement. And I took a trade, and, of course, it wasn't coming back. So don't get married to a trade. Set some minimum or maximum stop losses that you will have. For example, I want to ask a question here. Give me some responses. What would be a good, right out of the box, every time you made a trade, you placed this size stop loss? That's the question. Would it be a 10 pip stop loss, 20, 30, 40, 50? Which one of those stop losses would you think would be a good one? 10, 20, 30, 40, 50. This is good. See, there's a lot of responses all over the board from 10 to 50. Okay, other people say if you're doing the percentage, let me do that one first, even if that wasn't one of the answers, that's okay as long as you can calculate that percentage quickly and then get your stop on or have it calculated ahead of time. And then other people say it depends on the time frame. let me just use this as a scenario. Now, there's no right or wrong answer. It depends on what you're doing. I would say 10 pips may be too close in most cases. But I think someplace between 20 and 30, you just take a short trade, a short loss, 20, 30 pips. If you're wrong quickly. And then there are times when it will go down and take you out and head back in your direction. But that's when you need to, that'll help you to know when you should be taking higher probability trades. So just a general ballpark, my guesstimation would be 20 to 30 pip range. Depends on the size of the time frame you're using. If you're using larger time frames, maybe 40 or 50 would be better. So I don't know if there's a right or wrong answer, but I wanted you to figure out what you think is going to work for you. Now that you've made your decision, and many of you have written it down here, start using that time frame, not that time frame, the pips. On every trade you take, you set that as your stop loss on a demo account. Don't do it on your live account when you're testing something like this. On your demo account, you set the one that you chose and stick with it and test it out, see if that's going to work for you. I found some that I like better than others, and it's usually the 20 and 30 pip range is what I like to get taken out right away. If it turns and goes back the other way, jump back in. And when I get back in, many times I make up that 20 or 30 pips quickly, and I still make a profit on the trade. But test that on yourself. So thanks for your responses on that.
Somebody said, try the average hourly range. I like the little wider stop myself when I'm getting in, because it allows me to take a look at the trade. If I'm going to go into the position, I can move my stop loss in just a matter of a couple of seconds. If I want to use a swing high or a swing low, or reposition that after I get in a trade. And so one of our students mentioned that he didn't want to get stopped out right away, so he'll put on just a little larger stop loss. And so having something right out the gate doesn't mean that you have to stay there. If you look at the trade and it needs to be repositioned, do it.
So you've heard two things. Michael likes it a little larger, but I know Michael trades larger time frames also.
Right.
The time frames that I like trading are the day, the 4 hour, and the 1 hour. Those are the time frames that I like trading. And even on a 1 hour entering, I like a 20 or 30 pip stop loss. Because usually when I'm wrong, if I take the 20 pip stop loss, that was better to take that than the 30, because it then keeps on going in that direction that I was wrong. And that's what I should do, is enter and start trading the other way. So in my case, if I'm wrong, I have made a bad trade, and I need to get out of that quickly and get into the direction the market's actually wanting to go. Now, you can see, generally speaking, now right at this point, if this is all you were seeing from right in this little red area right here, this way, that is kind of an up trend. Let's move that over a little bit and see if we can see if it's really an uptrend. It's really been going sideways. Then had a news announcement. It came down a little bit, and then it took off again. Okay, now this pattern right here, get used to seeing this many times. And Michael and I had a discussion on this, and he said this is a pattern generally that the brokers or the money makers or the people that can manipulate the market, and that's about all that they can do. That's about as big as you'll see, is they'll head it in the direction opposite of what they think is going to go, just so people jump in, and then they take them all out and go the other direction. And that's how they'll make some money sometime. So this little sideways, when it's going sideways, it drops. Right here, it was going sideways, it dropped a little bit, then it dropped again and took off again. They're not all exactly the same, but to me that was a good example of a pattern you want to be aware of. And look to see how the indicators are looking at the time that happens. That's on a 1 hour chart. Okay, now let's go to a 4 hour chart in the same location. I'll put that line there so we can see where we're going. See what the 4 hour chart told us? Okay, the 4 hour chart said it had been going down here, but the momentum is starting to go up. And all the indicators say it's going up. So this was just a little retracement here before it took off and did this larger move right there. Okay, so don't waste time on a losing trade. And so if it was going to go against you, get out quickly and get going in the right direction. So that's what I wanted to share with you there. So at the end of the week, or a period of time that works for you, sometimes you might have an evening or a period of time that you can study the charts and just kind of look at what's taking place on your trades and look for charts and patterns. Now, we just showed you one pattern that can be effective in learning your trade. So go back and simulate trade that. Look for every pattern you can find that was just like that one and see what you would have done there. I want to go and show you another pattern that if you learn this pattern, you're going to be miles ahead of the game in your trading. This is called CDC, or convergence, divergence, and congruence. And see how I've drawn these blue lines here? Right here was a signal that said there was going to be a change in the market. It was going to go short. Now, that was just on a day chart. It wasn't a very big move. It was only a 150 pip move. Well, that's still a move in that direction. Then it tried again and tried again. So you saw that the trend right there was going down based on what we saw right there. Now I'm going to move across. I circled this box right here. How many of you can see convergence, divergence, or congruence right there? It was divergence. You can see that the general price was going up and the momentum was going down. So right in here, that was the point that said the market potentially was going to change. Now, this is not a day chart. How many days did it take? You count this as 1 day, 2, 3, 4, 5. On the 6th day, it actually took off. So this could be something you're watching for. You're looking for a pattern. And so during your reflective time when you're looking at things, and towards the end of the week or the weekend is a good time, it's not even necessarily bad if you did it on a Monday or Tuesday of the trading week. You can see what's taking place, and maybe each day you look at the chart and say, do I see any divergence or convergence on a day chart? That's a pattern you want to look for. Now, what happened right here? It was only about a 200 pip move. Okay, that was a great trade right there. Then, as the patterns and signals said to start going long again, look at this pattern right here on the bottom indicator. How many times can you find that when you had divergence, it went down below the zero line and popped back up and then made another run? Okay, this is a critical pattern right here. Right here is the best time to start trading. That's a counter trend trade because the momentum's on the wrong side of the line, but that grades out well. Now let's see how that trade would have graded had we just graded it. Okay, it gives us I like the 2s and 3s as the first grade. Now let's go to the 4 hour. We can see what happened after the fact, but we want to say what happened when it graded out like that. Okay, that gave a 3. So we got a 2, 3. Now let's go to the 1 hour. Well, there wasn't enough data. Okay, so let's go. We do the 4 hour, graded out, and then we go to the 1 hour, seeing it's off the chart. I didn't look at this before to see.
Okay.
But
I see.
I can basically give you heads up of that. If you get a 2, 3 within a short period of time, if not even right at that time frame, that would have been a 5 alarm trade on a 1 hour chart right there. So look at this pattern. Divergence goes below the zero line. Look for as soon as it starts changing right there. That's one heads up. It's a pattern you want to look for. Now I'm going to go to a different chart. I'll just grab one. Let's do the New Zealand US. I don't know what we're going to find here. I'm going to zoom out and see if we can find that same pattern at divergence. And many times it does happen, but not always. Here's a possibility right here. It's on a day chart. Well, it's not divergence, but it's the momentum on the indicator was getting closer to the zero line, and it went below right there. That's a time when you see that's a blue light special. Says, okay, there's a potential of making a trade there. So I've given you a little tip right there as to how to find trades after divergence, and it goes below the zero line and comes back up. You see that there was no divergence going on right here. It didn't give you, it just went down and changed colors, went back up, but it came after this one right here. You go through and find, that's an assignment. Go through and see how many of those you can find, and then say, oh, I'm going to look for that on day charts now. Well, what if you looked at it on a 4-hour chart as well? It would be the same thing. So the day of the 4-hour would give you a heads up in finding things. So study your charts at the end of the week, looking for patterns that can affect Forex trading. Okay, that's what one of the keys would be right there. Okay, focus on learning how to use indicators. Now, it's difficult to master the Forex world in the currency trading if you only focus on one or two pairs. I want to ask you this question. You can answer it if you want. How many of you heard over your trading career someone say, get good at trading one or two currency pairs? That's what I heard all over the place when I first started. And
Yep.
so I was focusing on the euro dollar and the pound dollar. And maybe sometimes I would stretch it out and do the Swiss, U.S. Swiss and the U.S. yen. Those would be the four major pairs that I would look at. As I got going, I realized that the Australian pairs moved as well, and many of the yen pairs moved also. And so I got thinking, well, what if I became good at the indicators? The indicators work on these two or three. Why not become good at indicators? Then I can trade all of the currency pairs. Then I learned another little technique. If you see one currency pair moving that has the Australian in it, look at all the other Aussie pairs. There's 4 or 5 other pairs you can look at, and many times you'll find some additional pairs moving. And then, what about if the euros are moving, or the pounds are moving, or the yens are moving, or the US dollars are moving? Whenever one of those currency pairs moves, look at all those pairs that have that same currency in it, all the dollars or all the yens and so forth. That's a way to find more trades. That's a way to trade more than one currency pair. That's becoming good at indicators. Wait until the market tells you it's moving, and then trade those pairs. That's where, instead of making one big trade of 50 to 70 pips, what if you made 6 trades of 50 pips? Well, boy, you had a good day that day. Several hundred pips, because you learned to trade indicators rather than trade one or two currency pairs. Plan trades in advance and never trade only because of the sudden price movement. Now, if you have some indicators that say when the price moves, trade it, that's okay, but that's probably a plan. Okay, there's one strategy I want to mention to you. It's called EBNA. How many of you have heard of EBNA? This is Clark came up with this. He's taking the indicators that we use in the Forex Strategy Secrets, and he's applied them to a technique that he uses very, I think that's the one he uses most of the time. I don't know if he uses much else other than that. He's fine-tuned it. So he says if the day and the 4-hour are headed in the same direction, which in this case they're not. The day said it's been going up, but the 4-hour said it's going down. You really look at them, they're both going sideways. So then you take your 1 hour. I'm not going to go through all the details, every scenario. You have to come to one of these trading rooms when Clark said, the European room or the US room. Go to the 1 hour. So it's what he's looking for here on the 1 hour time frame. He's looking for an early bird. So he's using the early bird and the Norwood alert. Those are the two things he's using. So I'm going to mark this. This may not be a good grade. but it's right there. What's happening right there? That is an early bird. It confirms it on a 30-minute. It did not confirm in my mind because it's different colors. But let's see if there's a 5-alarm trade. See, that's not a 5-alarm trade. And so he probably would not have taken that trade. Let me go look at for some others. I'm going to go back to this bar over here and scroll through quickly and see if we can see something. That's still a sideways market. That it is an early bird right there, but I can tell it's sideways and it's not going to be really that great. Let's try this one. This is not an early bird, but I'm going to mark where an early bird was. There was an early bird right there. I'm just trying to get you the basics of this little strategy. At that point, the 30-minute confirmed. Let's see if there was a 5-alarm. It was not a 5-alarm trade. So he wouldn't have taken that. Because what he had been waiting for is this 5-alarm right here. Okay, you noticed when what happened there? Now let's go back and grade that out based on, I'm going to hit the day. The day said it was going down, so it didn't really work. The 4-hour did say it was going up. So the 4-hour, look what I see here. See divergence right there. Okay, see this point right here? An early bird, or a blue light special. The 1-hour confirmed that right there. The 30-minute course confirmed that. And that's where there was a 5-alarm trade on the 15, and there was a nice little trade. This is what, when we're planning trades in advance, you can plan these EBNA moves. You can wait for a blue light special to go in the direction of the trend of the 4 and the 1-day charts. So in the trend alert, if you see the day and the 4-hour the same color, that's an indication that those currency pairs are going in that direction. You go to an early bird on the 1-hour, confirm it on the 30, and then take it on the 15 on a 5-alarm trade, you're going to have a high probability trade there. Okay, what would be another way of planning trades? Grading trades. Okay, say the day grades at a 2, the 4 grades at a 3, and the 1-hour is grading at a 3 also. You want a 5 on that 1-hour, little entry time frame. So you wait until the 1-hour gives you a grade of 5. So you set the early bird alert or the normal alert, bring it back to your attention, and when you see that, you've already planned it out. You're not worried about whether it was a news announcement. It was because it's set up and all the movement was in your direction. So use the normal alert and early bird alert to bring things to your attention. Stay calm and avoid getting overexcited when you are taking a lot of trades. This can lead to overtrading and give you a poor risk-reward ratio. How do you stay calm? Here's one little simple thing. Take a bunch of trades. If you have 5 trades on and one of them's going against you, you're not going to get too excited. If you have 5 trades on and one of them just flying through the ceiling and the others are kind of mediocre, maybe one loss, a couple of small pip profits, that's going to keep you a little more calm than if you only had 1 trade on and it was a big loss, or 1 trade on that was a big win. Then what would happen there is you would be so emotionally excited you can't hardly even understand what you're doing. Have a bunch of trades on. That'll be one way to calm you down. Don't get excited because 1 trade is not a career. It's one little thing. Don't say, I got this really big trade and I'm going to brag about that for 3 weeks now, and that's the only winning trade you had. So take a bunch of trades. That will keep you calm, keep you in your perspectives in line. Don't cut your profits short by closing the winning trades too early. Stick by your rules. So you need to have some rules. And what would be your rules? Well, use an exit signal or have a take profit. And when you have a take profit, what if it's getting close to that take profit? I like to protect some of that profit and use a trailing stop to protect profit, whether it's the Norwood stops or the nth degree stops, or I'm manually moving it up. Use a protective stop. That way, you can still get something out of that move. Let it kind of reach your take profit. And you'll find signals if it's not going to reach it, then close the trade. The other thing is trade the larger time frames. And then you have a chance of staying in a trade just a little bit longer. It takes out the noise out of a trade. You know that you've all been trading. You've traded a 15 and a 30-minute chart, or even a 5-minute chart, and it comes back against you and hurts you, close the trade. And then it turns and goes another 50, 100 pips in your direction. Well, if you'd been trading the 30 or the 1 hour time frame, or even the 4 hour time frame, you possibly would have received more pips and not cut your profits too short once you get a good trade going on.
Number 8 right here, just I'm thinking right off the top of my head, Kurt, this is really the issue that kept me in the basket as a winning then losing trader, then winning then losing trader, because I didn't let my profits run far enough. When I first started trading, I was anxious to get that showcase trade, a 50 or 80 pip trade that I could go show a whole bunch of people and say, hey, look, see what I did. That way the people who knew me, could at least be impressed for that moment. And trading isn't about impressing yourself or your family or friends. It's about following these rules. And number one mistake for me throughout my whole trading career has been cutting my profits off early. Many times a trade that I exit with 30, 40, 50 pips profit will be a winner if I look at my intermediate time frame, will run 100 or 200 or sometimes 300 pips. And I actually need those pips to fill out the journal and keep my profit factor where it's at. So exiting a trade is the most important part of what we do, I think.
I think that's a skill that is harder to learn than entering a trade.
Oh, it is. That is the one for me that has been hard, and I think you will agree with me. That is one of the toughest things to do. Any other comments on that?
Well, you have people have emotions involved in that. They got some. If it's real money, then they got money tied up in that. So now it's a real game, and so they get emotionally involved rather than building a trading account. They're trying to build a one-winning trade, the only one they had all week long. Yes, fear and greed. That's what happens when you're trying to figure out whether you want a closing. You're trying to figure out how to close a trade.
What I found that if I have, let's say, a 40 pip stop loss and I open up 3 positions, I let the first target be equal to my first stop loss at 40 pips. I let my second target be twice that, 80 pips. Now, if it backs up on me, I get to keep that, keep the 80 and lose the 40, so I'm net 40 pips or whatever. I forgot how it works, but I'm ahead of the game. Then I can let that last unit run by watching the upper time frames and see when it might become in danger, and I might close it, might let it do its drawback. But I already know I got a free trade because I made 40 pips plus 80 pips for 120. Now, if I lose my 40, I do still keep the 80. So that's an option people have. It takes the stress out of the trading.
Yeah, so that's a strategy that Bill's developed for himself. And I've heard similar type things that people will do that. So it sounds to me like you're building, trying to build your trading account and not rely just on one little trade to make it work. You're protecting that profit.
Yeah, I think sticking to your rules is important, especially if you're short-term trading, because it takes the emotion out of it. If you watch the indicators, like for my EBNA strategy, if I'm trading 1 hour, 30 minute, and 15 minute, and take a launch pad entry on a 15 minute, there are specific rules I follow to watch that trade, and if I follow my rules and I have a certain set of indicators I watch for an exit, and once those are met, then I get out of the trade with whatever profit the market wants to give me at that point, and then start looking for another entry later on. But the idea is, if you have a set of rules written down in front of you which guides your trading, it takes the emotion out of the trade.
Yeah, that's a big factor right there. And it doesn't have to be a big typewritten page. You could have a short sentence, 2 or 3 major rules. You got your detailed rules written down, you kind of follow, but if you got those 2 or 3 critical things as far as, okay, it's set up, now I'm going to enter, or it's set up, now I'm going to exit, and have a couple of big short sentence, quick reference rules you can glance at, and that rule just jumps out at you.
Even if you do follow your trading plan, sometimes you will find that perfectly following your trading plan will get you out of the trade before it reaches the end. Because I had a trade last week, I entered on the day chart, and when I bailed on it, it still had 140 pips to run. So, but
it's a good point. I'm glad you brought
my target on it.
I'm glad you brought that up because we can always find the exception. Oh, if I did that one, it would have gotten me more. Or if I stayed in this, I would have made less or suffered less of a loss. The main thing is, if you want to determine whether it's a successful trade or not, is did you follow your trading plan? If the answer is yes, it was a successful trade. If it was a loss, it was still a successful trade. That's what you mentally have to get used to is, did you follow your plan? I've listened to really experienced, successful traders, and that's what they say. This guy, he says, you've lost big on a trade. Did I follow my rules? Yes. It was a successful trade. I made a little bit of profit, closed the trade. Yes, that was a successful trade. The most important thing is following your plan. And then you have something to grasp onto. And just like Tommy said, yeah, I lost some pips there. That's where you have to say, that's okay. I can give that up. I'm going to go with the that I did what was right. I did what I had planned. If you plan to make 15 pips on a trade and you closed it at that point, that was successful, even if it runs another 30 or 40 pips in your favor. At the time, you made that decision, and so that's great. So thanks for bringing that up, Tommy, because that's a big part. We don't want to beat ourselves up because we lost something if we did things right.
And what's the old saying, don't cry over spilled milk?
He's got an example here of a grade of 3-3, then he's waiting for that third grade bar to be a 5. And possibly in this case, a 3-3, sometimes I would take even a 4. But 3-3-5, and it says, how sure can you be that the next bar won't go against you? And if it does, should you stay out? I would say it may not go against you, but it may not give you the 5-alarm trade. So I would say if your rule is to take 5-alarm trades, then stay out. If your rule is if you have the larger time frames going in your direction, you will take a 4-alarm trade. 4-alarm trades many times are launch pad entries. And they can be very good entry points. And so they can't say yes 100% of the time, stay out or get in. But the thing that I would say is, if it graded out properly, take a few of them and see what your experience turns out to be. I think you find that if you take at least a launch pad entry with a high grade of a 3-3, those larger time frames, you're going to be trading in the direction of the trend on those larger time frames. And you'll have some good experience in a few trades to know really what you feel like you can do.